the way they did it is that you continue to learn, and I think they were advancing it. So I think you can try another standard you think you are comfortable with. Um, then try another one. Maybe it might be whatever. So Amina is asking, are we to do 5 and whatever? Just do anyone as then almost all IA standard is there. Just do the one you feel like doing. Me, I just feel like okay, you can just attempt as much as you can attempt, but it's not
I
difficult.
think I will not do it under duress. I will relax and do it. Maybe because
Definitely do it
just
under
want to do
yeah.
it and bring it. Maybe that's why. I will calm down and do it. I must pass it. Kilo day.
At least I expect you to even score like maybe 67, 68, even in those attempts, not 40. Even though 70 is the pass mark.
As in, I've been stuck on 40. I don't know what I'm doing wrong, or maybe I'm not reading. I will take my time. I must get it say. I'm
But
vetting for it.
the most important thing is that I think the platform is just impacting because I think they have a details, even
Yeah, it's
procedural
kind of
explanation.
friendly. Yes,
Yeah.
it's very friendly. And I had to, you can't even, going through the materials is actually key. It's actually key. It was really helpful. Thank you for sharing.
You're welcome. You're welcome. So I think we can start. We are almost like 10 minutes behind now. And I think there's also misunderstanding as to the timing. We are very sorry. There can always be misunderstanding. Okay. All right. So we'll be looking at IFRS 10, right? So which is consolidation of financial statements. Um what does the learning objective? What is the learning objective of IFRS 10? So basically, IFRS 10 requires that a parent company shall consolidate or present a consolidated financial statement when it controls one or more entity. So a parent company or entity is supposed to prepare what we call a consolidated financial statement. So when we say parent company, I think I just gave a brief overview last week, but I'll still go over it again. A parent company can be in different form, right? And I'll tell you when you can be a parent company. Okay, let me just do. I think I have it down. Exemption. Okay, I think I have it down. Thank you. So the standard does not deal with the accounting requirement for business combination and their effect on the consolidation, including goodwill arising on what business combination that I've done in IFRS 3. Nor does the standard deal with the accounting for requirement for separate financial statements. And I think you have dealt with how to prepare separate financial statements. So when you've learned how to prepare separate financial statements, you've learned business combination. When it comes to consolidation, it's more very straightforward because separate financial statement has been prepared. You are just adding, like when I said, when they say condition means adding one report to another report. That is what consolidation mean. So, but there are some companies that are exempted. There are some parent company that are exempted from preparing consolidated financial statements. IFRS 10 provide an exemption to a parent company from presenting consolidated financial statement if all of the following conditions are met. One, it is a wholly owned subsidiary or partially owned subsidiary. So what it means is that if A acquire 70% in B, A is automatically the parent company to B and B the subsidiary. Now, if B, or let me say if A, another company E now acquires 70% in A, by that effect, A has become a subsidiary of E. So A is not required to pay a consolidated financial statement because on his own, is also a subsidiary to another company. Does that make sense to us, please? Does that make sense to us? That is number one. Number two, if the equity instruments, if the company is not traded on the stock exchange, any company that is not publicly traded is not required to prepare consolidated financial statement. That means even when you have that holding structure but the company is not trading on the stock exchange, whether London Stock Exchange, whether Nigeria Stock Exchange, you cannot prepare a consolidated financial statement. But you can for management consumption purpose, not for the public, just for internal consumption, but not for the public. So if your share is not listed on the stock exchange, you cannot. It did not file, no. It is not in the
Please,
process of
can you come
filing.
back with that again, sir? Can you come back with that? What he said? Sorry.
Okay. Any company that is not listed on the stock exchange, be it Nigerian Stock Exchange, London Stock Exchange, New York Stock Exchange, even if you're a holding company, you are not required to prepare a consolidated financial statement.
Okay.
Or
Yeah.
is it the first one? Any company that is not publicly traded is not on stock exchange markets, whether Nigeria, London.
For management purpose, right?
What did you say?
They can do that for management decision purpose.
I think you are a little bit far away from the mic. I don't know whether it's me.
She said that can it be prepared for the purpose of management?
Yes, I said that. I said you can do it for internal consumption only. You can do it for internal consumption only, just for the management to make decision to say how are we doing. But it is not required in line with IFRS10 for you to do it because you are not publicly traded. Can we continue, please? It did not file.
Yes.
No, yeah, I want to say
What
something.
about for audit? Can I ask you? What about for audit purpose?
For audit purpose, okay, for audit purpose, when you say for audit purpose, what do you mean by audit purpose? To say
For
in
example, now I know when I audit most of these group companies, they have like so many subsidiaries in South Africa, in Asia, in maybe in Switzerland, different countries, and then maybe head office is in UK or head office in US or something. And if I
yeah,
audit the company, after maybe I might be auditing the one for the UK, and then other entities in different countries are doing their own auditing. Then when it is all done, then I will create a bridging document which bridges it to maybe US GAAP, for example, if
yeah,
it is USA or if it is other countries, not USA, it will be maybe IFRS. If it's most likely, if it's going to be consolidated and other countries are this thing are coming in, it will be IFRS. So
yeah,
I'll do bridging document to IFRS. Maybe if FRS if you revenue, if we use FRS 102, section 23 of UK GAAP, then I'll change it to IFRS 15 and do it in line with it. Then also leases IFRS 21 or 20 there, FRS 20 or thereabouts. Then 18 or there, but I'll change it to IFRS 16 because in the UK we do expense straight, but IFRS 16 we do expense, we do right of use and all of those things, assets. So by the time you do all of that, then we then send it to the group, then it is consolidated.
So let's look at, can you see my screen? Can you see my screen? Can you see the screen? Or what can you see?
Yes, we can.
So
Yes.
I don't know what you're talking about. Look at this UK entity, right? This is German entity. This is Russia. This Russia is not just only Russia. Some other components are in that Russia. This Russia include this Russia should have been called Europe, but we can't call it Europe because Germany is also under Europe. So this Russia is one of the strongest units. But under this Russia, we have France, we have Italy, we have Czech Republic on it. This is a different unit that was also created in Germany, right? And this is the group. However, see Germany as a pop retail is just a different entity in Germany that it was acquired. These are different entities in different countries like Italy, Czech, Russia, and France. This Germany, another entity in Germany itself. That means there are two entities that was acquired in Germany. And this UK. All this one here, they are not listed on the stock exchange, but UK entity is listed on the stock exchange. So I want to get that scenario. Is it that the one you are doing is listed while all these are not listed?
Most times most times most of those companies are not listed. Only a few are
Head
listed
office
stock
on the
exchange.
UK one. The
Why
auditor
I
will
mean that most time the group holding company is not
yeah.
listed.
Yeah. So if the group holding company is not listed, so why for audit purpose, definitely you might necessarily need to consolidate. And why do you know the reason why you are
For
consolidating?
tax purpose.
For tax purpose. For tax purpose. Not for that task for tax
And
purpose.
also to uh, go on.
Continue.
Okay, for one, for tax purpose. Number two is also to know what the group profit is and the group position is
That's what I
at
wanted
a
to say.
glance. Yeah.
For that for tax purpose. But it can be based on region to region, right? Region to region. In UK as a whole, you can do that, but in Nigeria you cannot do that because I went ahead to buttress the difference between a group and a holding company. There's one between a group and a holding company. Now let me bring it down. Let's basically in Nigeria we have what they call heavy holding.
Mm. Holding
Heavy
company, in my according to my knowledge, holding company is just like a SPV. That's what I see it as.
SPV, thank you. So if in the case of an SPV,
Yes.
you don't need to
Of
it
course,
doesn't
obviously, you don't need to, or you are having it for a particular purpose of maybe to pay management charges or to pay payroll or to do something or to do one thing. So it's usually like that.
exactly. So but in other case, if it's not an SPV, then you consolidate for tax purpose because there are other things that will have come in.
And
There are
group
other
release,
revenue that
yeah.
will have come into the entity's accounts. Yes. 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 Yeah, that's correct. So that makes sense. I'm not
Yes,
speaking
yes.
to Moses, I'm talking to others. Does that make sense to us? Because my guy is speaking at high level. Does that make sense to us?
About to stop whining me, FCA.
Yeah.
FC Colofin Bone Banking. Does that make sense to us, please? Okay, let me re-explain that aspect of the holding and the one of the group. So we can have a group company, we can have what we call an holding company. So our holding company in the scenario where we have, let's say, FBN holding. In Nigeria, we have what they call FBN holding. FBN holding is just standing there as a kind of, is like I will call it a portfolio SPV, like the word to use, but it's like a portfolio. But FBN holding does not do anything, does not trade, right? But under FBN holding, that is when we have the bank, the insurance, the mortgage, and all other entity. Now, you have some certain kind of portfolio in this kind of structure. You have the portfolio of group finance director, or let me say, I don't want to use the word finance director, I should use group CFO, group marketing manager, group operational manager, group certain portfolio in that particular group CEO. Those portfolio, the group CEO of FBN Holding does not mean that he will be sitting in an office FBN Holding. He can even be sitting in an office as maybe mortgage bank, FBN mortgage bank. The group marketing manager can be sitting in insurance, even though the CEO of insurance bank is still sitting there. There will also be an office for those ones. So, but the question is that this portfolio, they are just standing there as a portfolio. The only thing FBN Holding does is paying those, because those people like that, they are indirectly an employee of FBN Holding. That's why they're holding that portfolio, right? Pay them salary. But in terms of operational activities, they don't do anything, right? The as in FBN Holding does not have day-to-day operational revenue or expenses apart from the one of that operational staff. Now, in that scenario, FBN Holding is the one that is having equity in each of those entity, bank, insurance, and all the stuff. Each of those banks or entity are required to prepare their separate financial statements and pay tax on it. When they are preparing the group account of FBN Holding, right? Because it's like it's like an SPV, because it doesn't actually have anything to do. FBN Holding itself does not need to prepare financial statement because it's not having, it's not generating, it's not a generating revenue generating entity. So that is that case. But in the case of the in the case of the consolidation we are talking about here, we are saying that entity that is in operation acquire equity in another entity. Entity that is in operation, A, is operating, it has it to the operational activities, generate revenue, incur expenses, involved in daily activities, acquire equity in another entity that also does that. That is the case. That's what we are trying to say about. We are talking about here. Does it make sense to us, please? Does it make sense to us? So,
Also, there's something I was going to even say. There's some things that we used to notice when we were doing exam in Nigeria then that does never make sense to me until I got to the UK. I don't know if you notice all this old co, mid co, big co. I can't questions to carry those things a lot and even practice questions. They carry like mid co, bit co. Those things actually exist in the UK. Like every firm I've worked in, anywhere you go to, you just hear, I have a mid co. They all understand what it means. I have a old co. They all understand what it means, and I struggle to understand what they mean. So, but every 10 person that you speak to understand what's a old co, a mid co, a bit co. So they just mention is a bit co, is a old co, is a clinical co. So those things that we use in exam in ICANN then that they mention bit co, mid co, they actually exist to so like what Mr. Badu is explaining is like an old co in the UK. So something like that.
okay. So, he did not file or nor in the process of filing financial statement with a security commission or other regulatory organization for the purpose of issuance of any class of what instrument in the public market. And the last one, this last one that I'm putting here, for me, is not part of the requirement, but I me personally put it there. It's ultimate or any immediate parent produce consolidated financial statements that are available for public use and comply with IFRS, in which subsidiary are consolidated. Is like an extension of this first one that I put there. So you see a scenario where the sub by one way or the other is also providing a considered financial statement. Okay. So the next one I want to talk about is understanding control. Basically, we know what control is, but we just want to talk about what control is. And we said that control exists when an investor is exposed or has the right to variable return from its involvement with the investees and has the ability to affect those return through the power over the investees. But however, there are three elements of controls according to IFRS. Number one, power over the investees. For you to have control, there must be power over the investees. Two, exposure or right to variable return from its involvement with the investees. That means for having control in that investee, something must come in return. The ability to use its power over the investee to affect the amount of the investee's return. That means based on your power, you can affect how much the investee is going to generate. The next one we want to talk about is consolidation procedure. Now, I told us that when you are consolidating, the first thing for you to do is to determine the group structure. And when you are determining the group structure, it's very easy to understand, to know what the group structure is. For you to know what the group structure is, that means you need to walk through the words incorporation document. But that's where you're going to see that documents will tell you that. Know when the application date is, because it is from the application date you know what to consolidate or what to put in the book or not. Because anything that is generated, any revenue that is generated before the acquisition date will not be taken into consideration in the reporting date or the date of consolidation. The group income surplus, know what the group income surplus is, and know what the non-controlling interest is. Now, IFRS10 outline the consolidation procedure and requirement for preparing consolidated financial statements. During the consolidation process, the financial statement of the parent company and the subsidiary are combined on a line-by-line basis. You take them on a line-by-line basis. This involves combining like items with like items, assets with assets, liability with liability, equity with equity, income and expenses line by line of the parent company with that of the subsidiary. Notes. Notes. Before the financial statements are combined, adjustment may be necessary. You might need to do some adjustments, right, to ensure conformity with what? Group accounting policy and reporting dates. What this means is that reporting dates, accounting policy. Thank you. So what this thing means is that if the reporting dates or the accounting policy of the of the of the parent company and subsidiary are not the same, you might need to do adjustments to them. Say for example, the reporting date of the parent company is 31st of December, while that of the subsidiary is 30th of June. It will be very difficult for consolidation to be possible because they are not like times. There will be gap. There will be gap in the words in reporting profits and reporting some item in the financial statement. They definitely go to gap. So there might be need for you to what? To do adjustments. Am I making sense, please? So let's come back to this. Let me come back to this on a check. So non-controlling interests in the consolidated statement of profit or loss and other comprehensive income. Identify, the first thing to need to do is to identify the non-controlling interest in the profit or loss and other comprehensive income of the consolidated subsidiary for the reporting period. Don't forget, the reporting period is always the end of the year. Profit or loss and each component of other comprehensive income attributed to the owners or the parents and to the non-controlling interest. Amount should be attributed to the non-controlling interest, even if the results in the non-controlling interest is having a deficit. I think I will still talk about negative. I think I will mention it. Negative profit or non-controlling interest. Non-controlling interest in the considered financial position. Identify the non-controlling interest in the net assets of the consolidated subsidiary separately from that of the what? Parent ownership in them. Non-controlling interest in the net asset consists of 1, the amount of non-controlling interest in at the date of original combination calculated in accordance with IFRS 3. 2, non-controlling interest share of change in acquisition equity since acquisition. Non-controlling interest at the acquisition date can be measured either at fair value or proportion to the share in the net assets. Non-controlling interest in the net assets of a consolidated subsidiary are presented in consolidated statement of financial position with equity but shown separately from the parent equity. Let's go back to this knowledge check. I think we'll be able to understand what they are telling us there. Who would like to read for us, please? Want to read for us, please?
Okay, let me read. P Limited bought 100% share in S Limited on the 31st December 2018. The individual statements of financial position on the same date are as follows. The individual statements of financial position on the same date are as follows. P Limited, S Limited, non-current assets, the values there, investment in X Limited, net current assets, share capital, income surplus. You are required to prepare a consolidated financial statement for P Limited Group as at 31st December 2018. Thank you.
Thank you, Dad. So one of the things that we should note is that anytime we are consolidating, we don't consolidate investments in the subsidiary. We don't consolidate investment in the subsidiary. anytime we are consolidating, we don't consolidate investment in the subsidiary. And I said anytime we are consolidating, the first thing we should note is to know what is the group structure. That's the first thing I told us we should know. So in this scenario, what is the group structure? What is the group structure?
100% purchase.
100%. 100%. 100%. It's just 100%. So the first thing we want to look at is to look at our group structure. Group structure. Our group structure is parents. Parents. Parent is 100%. NCI. Our NCI is 0. That means total is 100, right? That's our total. So the second thing we want to determine, once we have been able to determine the group structure, the second thing we want to determine is to determine what is the goodwill at acquisition. What is the goodwill at acquisition? What is the goodwill at acquisition? For us to determine the goodwill at acquisition, okay, should I answer the question by myself or I should ask you? What is goodwill at acquisition? Goodwill is even between what and what? Two items. Goodwill is even between two items. What and what? You can see it from this question. Goodwill is even between
Purchase consideration.
purchase condition
Let's
and what?
let's net asset of fair value of net asset plus NCI.
So what is our purchase condition in this scenario?
Sorry, I'm using my phone. I can't see your screen clearly.
You can't see my screens.
Clearly, it's
Want
not
to answer
bold.
apart from you. What's our purchase condition in this scenario? Purchase condition is there. They did not tell us is that purchase condition, but you can see it indirectly. Is that they are telling
Okay,
us
P Limited bought 100% shares in S Limited. Sorry, I just want to read on the 1st December 2018. I'm in the bedroom, sorry. The individual statements of financial place. P Limited bought 100% of S. Okay, now that's set to this 80,000. Investment in S Limited, that's 34K.
that's 34K.
Yes.
That's our purchase condition. That's our purchase condition. Thank you. So what's our net asset?
That is straightforward now. It's there now.
Is there
Yeah.
28,000.
Yes.
That's just it. 28,000. So we just say calculation of goodwill
Sorry, I'm in the bedroom. I'm sorry.
at acquisition. So which is purchase consideration minus net assets. So our purchase condition is 34,000. And our net asset is 28,000. Okay? Making sense, Abi? Okay. I'm moving to £8,000. So once we determine our goodwill, the next one we want to determine our group income surplus. Determine our group income surplus. Something okay, I'll remember. I wanted to say something, but I can't remember. Group income surplus. What I wanted to say. I wanted to say something about this NCI. Remember. Our group income surplus. That's the next thing we're supposed to do. Our group income surplus. Our group income surplus is just the surplus of the what? Of the holding company. Which is what? Which is 30,000. 30,000. 30,000. Okay. 30,000. Then the next we want to do is to determine what is our non-controlling interest. Our non-controlling interest is just 0 because it's 100% acquisition. But assuming it is 100, then assuming there is not 100, assuming the parent structure is, let's say, 70-30, 60 60-40, it will have, I think that's what I wanted to say, it will have impact in the way we'll have actually treated some items there. And I think I will still give back to it as I'm solving now. Something will come up and I'll solve it. So for us to go ahead and consolidate, so the next thing we want to do is to just consolidate our consolidated balance sheets.
So why not just tell us how we can get the NCR? If it was 30%, it will be 30% of what?
Yes, I'll modify the question as we go on. Yeah, definitely I'll do that. I know I wanted to do something consolidated statements of financial position. Okay. So in this scenario, we have our NCA. Our NCA parent T S and group. Our NCA for the parent is 80,000. Okay. So our NCA for the subsidiary is 25,000. 25. Okay. So the next one we go to is investment in subsidiary. I told that we don't consolidate purchase consideration, the investment in subsidiary. We don't consolidate it when we are doing our consolidation. We don't consolidate subsidiary, right? So that will be left out. Then we have our net current assets. Net current assets. Our net current assets for the holding is 6,300. 6,000. 3,000. Okay. And then something is missing. Goodwill should be missing here. But I'll come back to the goodwill. Goodwill. I don't need to come back to it. Goodwill. How much is my goodwill? My goodwill is 6,000. Then we'll come back down to our equity side. Under our equity, we have the share capital, right? The share capital is 90. Share capital. $90 and income surplus. Income surplus is 30. Okay. Control. Okay, so these are our group balance sheets. We have this scenario because everything we have here is 100%. But if the group structure is 70-30, by the way, this should be Control Shift tilde. Control Shift tilde. Y. Control. Here's my shift tilde. Is anything changing? What is changing on my keyboard? Okay. Let's do something else. Okay. 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 So this is a scenario when there is 100% acquisition. So 100%. %70%. Right. My question is, what do you think is going to change in the case of 70% in this whole of calculation? What do you think is going to change? What is going to be imparted? I don't even want, what is going to be imparted? If you have to be 70%, the first thing I think you should tell me, if it is 70% from the calculation of the goodwill, what do you think is going to be imparted if it has to be 70%? So if it has to be 70%, the first thing that will be imparted is the percentage of the goodwill. This goodwill won't have accounted for this goodwill 100% because they are not acquiring the whole of the goodwill. They are only acquiring part of the goodwill. Does that make sense? Does that make sense?
Yes.
So that's the first thing. The first thing that we first of all change is this goodwill. It's going to be the percentage acquisition of the goodwill. It's because it is 100%. When we calculate about this goodwill is 100% on the whole of the whole of the net assets. So assuming it is 70%, we are going to be apportioning the goodwill. We are going to be apportioning what? The goodwill. That's the first thing that will change. What other thing do you think is going to change as well too? Tell me one more thing that I think is going to change. Tell me one more thing that you think is going to change. Tell me one more thing that you think is going to change. Talk, time is going on. Tell me one more thing that you think is going to change. What other thing is going to change, please? One more thing is going to change apart from the goodwill. What other thing is going to change?
I'm assuming that the net current assets will be at 70%.
Yes.
the net current assets also be at 70%. That's the changes. That's just the changes. So the goodwill is going to be changing, the net current asset is going to be changing because both of them are at 100%, and they can't go at 100%. They have to go at what? At 70%. Once you adjust that, your group balance sheet balance. Once you adjust that, your group balance sheet balance. So if, for example, I take this one to be times point 0.7, right? Am I sorry? No, no,
Is the S part.
sorry. Where's my goodwill? Did I just bring this goodwill here? Oh,
Yes.
why did I
Just
just
need
bring
to
it
remove.
here? I don't know. Let me just assume times 0.7. Why did I bring it here directly? I'm wondering. That's my goodwill. Then why did I bring it here? Sorry, I won't
Just
bring
say
the
should
goodwill.
be
I
before.
won't bring it here. I'm sorry. I shouldn't have brought it there. I don't know why I bring it there. That is my goodwill. That should be 6,000. Right. Right. So times 0.7. Right. Then my I want to take it on individual basis. This would be times 0.7. No, I want to use it that way. Right. I want to 0.7. Right. Oh,
You didn't add equals to sign.
yeah. I did also sign. So what else? Then I don't want to tamper with it. Thank you. So in fact, this is wrong. Oh. I'm sorry. Oh. Because this share capital and income surplus belong to the holding, not to the subsidiary. So it's supposed to be here. The first one I did. I'm sorry. So in consolidation, right? Net asset 80K. I think I can copy these two down. Right. So basically, 25K. Okay. Thank you. So because the company P is acquiring 70% in S, so we are going to be apportioning the percentage of the equity. So the percentage of the equity, I will just put my 70% here. Right.
You're on the wrong one.
I'm on the wrong one. I'm not on the wrong one.
Oh yeah, you're on the right one now.
Yeah, so let me just set 70%. In fact, I'll put this 70% here because I will be using that 70%. Control S. Right. So is equal to this multiplied by this. I will lock this in because I don't want it to move. By drag down, will it work?
Yes.
Making sense, right? If I drag down again, will it work? Making sense. Make sense, Abby?
Yes.
Yeah, makes sense to me. Okay. So share capital for S, 90,000. Can copy down. right? But something is missing that's not beginning to balance.
NCI.
NCI, NCI, non-controlling interests. What's our non-controlling interest? How do you get our non-controlling interest? How do you get our non-controlling interest? What's our non-controlling interest in this scenario? How do you get our non-controlling interest?
Is 30%
Percent
of
of what?
Net assets.
Of what?
Assets.
Of what?
Net assets.
Net assets. So we have. Let me just bring my.
But we need balance.
Definitely will balance. NCI. Our NCI is equal to net assets.
Sir, is non-controlling interest under the equity side or under the asset side?
Sorry. Sorry. NCI.
Okay.
Yes.
So if you balance now.
NCI. Our NCI is this figure. I will lock it. Multiplied by. Do I have my net assets somewhere? Do I have my net assets somewhere? No. No.
Yes,
Okay.
26,000. That's 26,000. When you are calculating consideration, I mean goodwill.
No, now the net asset is supposed to be 28,000.
28,000. Yeah, I'm looking for the 28,000.
Yes.
Whether I have some, whether I have it somewhere,
When you have
somewhere.
your
No,
Yeah, yeah, I have
calculation
it.
of
I have it up.
goodwill,
I have it up. I have it up. So my NCI is equal to this log multiplied by this. It's not balancing. Why? Why is it not balancing? I've taken my 170, right? 70, 70, 20, 30% my NCI, right? 100. What is Amanda taking? What is Amanda taking? I've taken my non-controlling interest. I don't need to take investment in subsidiary. I've taken this. I've taken this. 70% of this. 30% of this.
let's check the difference from there to give us
1,800. 1,800. This is my goodwill.
the goodwill.
Am I taking my goodwill at 100%?
Oh, okay, your goodwill should be purchase consideration minus
Must my goodwill? I'm taking my
seventy
goodwill at.
percent of
Yeah, yeah. That's my goodwill. I'm not going to apportion my goodwill.
yeah, we're supposed to do
Yes.
purchase consideration minus 70% of net current assets first to
Yeah,
find the goodwill.
I'm not apportioning my goodwill. So that's the only thing that would change.
Okay, so I want
If
to ask a
yeah,
question.
yeah,
So the idea of not you can't hear me.
partially I will manage, but like you're a little bit away from the mic. But I can hear you. Yes.
So I wanted to ask that the
Better.
idea of not consolidating equity is that the purchase consideration minus the non-current assets. Sorry, minus the net assets. So that sum is already included in the goodwill, right? Because I'm just
Yes.
wondering.
Yes. That's just the concept. Because there's a way it is being worked out, and the way it's being worked out is derived from the issue of accounting equation, right?
Okay.
It's derived from the issue of accounting equation, but basically it will amount to what we just said, and that's the reason why we are not actually adding the we are not adding the equity, because on a norms, see, the equity should be 28,000, right?
Yes.
And the purchase consideration on the norms, if they pay what the equity is as the purchase consideration, that means the equity and purchase consideration will be the same, unless we have a negative goodwill. Do you get what I just said?
Yes, I get it.
The net asset is 28. If they pay the same amount of the fair value of the net asset as purchase consideration, that means there won't be goodwill. But if they pay a lower amount of purchase consideration, that means we have what? We have a negative goodwill. So what it means is that indirectly, this has cancelled out each other, is zero. If you have reported this up and down, it will have been zero, right? So we are not, because we are not reporting, we are reporting this goodwill, which is the purchase goodwill, because that's what we are reporting. So the only way we can report the equity is if we have reported the invest purchase consideration itself. If you report the purchase consideration, we'll have reported the what? The share capital of the subsidiary, and it will have make sense. Otherwise, it will not balance. Because if this purchase consideration 28,000 is up, something must be crediting it down, which is what? Which will be the net assets. But we are not reporting the purchase consideration up. So what will be the credit side of it? Does that make sense? Does that make sense,
Yes.
please? Because something must be is a debit credit. If we debit our assets, right, or we credit our net equity 28,000, liability we credit 20,000, the net assets. So something must be up, which will be that the purchase condition, and we did not do that. So we only recognize what? The goodwill. So the only way it will balance if we have recognized the whole of the purchase condition, then inside the purchase condition there is a goodwill inside it already. So we won't recognize goodwill separately. And the law does not provide us to do that. Does that make sense, please? Does that make sense, please? Okay. So this is how you report it, and very invariably, that is what this line is telling us. Identify the non-controlling interest. Okay. If I talk about this, non-controlling interest in the consolidated financial statement, identify the non-controlling interest in the net asset of the consolidated subsidiary separately from the parent's ownership interest in them. Non-controlling interest in the net asset consists of one, the amount of those non-controlling interests at the date of original combination, calculated in accordance with what? IFRS 3. The non-controlling interest share of changes in equity since acquisition. Non-controlling interest at the acquisition date can be measured either at fair value or proportion to share in what? In net assets. Non-controlling interest in the net asset of consolidated subsidiary are presented in the considered statement of financial position within equity, shown separately from the what? Parent equity. All right. So we have a reporting date, and what reporting date is saying is that for you to consolidate, the reporting date of the holding company and the subsidiary must be the same thing. The financial statement of the parents and the subsidiary used in preparing consolidated financial statements shall have the same reporting date. When the reporting date of the parent or the subsidiary are different, the subsidiary prepare for consolidation purpose additional financial statement or information to that date. That means if, let's say for example, the parent company year end or reporting date is 31st of December and the subsidiary is 30th of June, the subsidiary need to provide additional 6-month account to meet to the end of the year for consolidation to be possible. Otherwise, it will be impractical to consolidate because of difference in reporting profit, and it will actually result in complicated adjustments. If it is impractical for to prepare financial statement as of the same date of the parent, the subsequent financial statement prepare a different date can be used for consolidation purpose, provided that all the following conditions are met. Adjustment was made to that effect. Difference between the reporting date of the subsidiary and the parent company should not be more than 3 months. Yes. There should be consistency in the length of the reporting dates. And any difference between the end of the reporting date and the end of the period and the end from period to period. So you can still also consolidate if the difference is no more than 3 months. That means the subsidiary is 30th of September and the holding company is 31st of December. Otherwise, if it's more than 3 months, the subsidiary or the holding company, either one of them, need to prepare an account to make that period or need to make necessary adjustments in terms of saying, providing additional information to say, this is what is going to be the profit at the end of the whatever, at the end of the 6 month period. That is what is going to happen. A significant impairment of major non-current assets belonging to the subsidiary would be an example of significant transaction requiring adjustments between the two reporting dates. But the best scenario is that the reporting dates are the same. That's the best scenario. Okay, entity A and entity B. Entity A is a subsidiary of entity B. Okay, entity A is a subsidiary of entity B. Right? Entity A has a reporting date, reporting period end of 31st December. Entity B has a reporting period end of 30th of June. Entity B must either change its accounting to 31st of December or prepare additional financial statements to 31st of December. This is because there is currently more than 3 months difference between the reporting end period. Then accounting policy. The same thing that is applicable in terms of reporting date also applies to accounting policy. If a subsidiary use different accounting policy for like transaction and events in similar circumstances, appropriate adjustments are made to the financial statement in preparing consolidated financial statements. That means, okay, a subsidiary may have different accounting policy if one, it does not prepare financial statement under IFRS. So let's say the subsidiary is based in a lot of companies in Europe use IFRS. A lot of companies in the Middle East use IFRS. But when we take away Europe, Middle East, which other continents?
Africa.
Asia. What did you say? Africa. Did you say Africa?
Yes, yes.
Yes, Africa use IFRS. I think Asia also use IFRS.
I had a question.
Yes.
Okay. So my question is this. I was auditing a client sometimes a few months ago, and then where we did the PPE of the client the client is in, I think, Dubai. So the company, the group holding company is in Dubai. So now this was what happened. The PPE was by according to the client is done straight line method in Dubai. But in the UK entity, we use reducing balance. That's what they use. So then EY is our group component auditor. While we are the component auditor, they are the group auditor. While we are the component auditor to EY. So then EY then said that we should prepare we should give them a bridging document that translates that what's it called? That's reducing balance method to straight line method. So I want to know. I just want to know what does the standard say on that? Because when I went to check the standard, because I argued with EY on that, I went back and forth on them, saying that it does not make sense because I did not. But I do not believe that the IFRS tells us to do that. Because according to the IFRS, we're not supposed to translate, we're not supposed to change, we're supposed to use the same policy that has been used here in the UK to report the account to them, since we use reducing balance method and they use straight line method in Dubai. So we're supposed to reduce our reducing balance method of PPE and give them the PPE figure at the end of the year as at 31st of the closing reporting period. And then they're supposed to just put it in their book. So, but EY for some reason said we should go and we should give them a bridging document that gives the straight line. So now I have to now start doing like a retros because it will lead to retrospective adjustment because if you are changing
Yeah.
what's it called from straight line to reducing method, it means you're coming to IS8. It's a change in accounting policy. So I had to now go and do retrospective adjustment. I took it back to the day, the latest, the earliest assets they had. So I had to look at the company's policy first. The company said it's 5 years. So I had to strip off every asset that were bought after 5 years and kept them at new balance. Then every asset that were bought at 5 years downward, and I started I recalculated for them, doing like a depreciation schedule and everything for them and net book value for them year by year up until so I can get the exact value. So I can be able to put that in the bridging document. But that was a lot of work I had to do because even the client could not do it. I had to do it for the client. So now, in such a case, what do you advise in that situation? Did you think it is right? Because I told Iwa that it doesn't make sense.
I would think EY is right, and I'll tell you the reason why I
Don't
would
say
say
because they are EY, say they are right though. EY is always wrong. Go. EY is number one wrong audit firm I've known in my
I
life.
I'm not
I
because
beg,
it's
oh,
EY.
why are you saying?
I'm sorry, I mean I'm sorry you are part of EY, but I'm sorry, but EY, sorry, this call is recorded. I'm sorry. EY is a very good firm. Sorry.
Ah,
I won't put
Kilode.
this call out. I won't put it out. I'm telling you, I know what I'm saying. I've worked with many EY, not just one, two. They are the only one
No, you just
that's
have to understand the basis of why they are saying that, and let's go and
no,
check
not
the
just
standards.
that.
If the
If
standard
I
also
said
says
I've checked
that,
the standard, okay, what does the standard say, Mr.
Okay,
Badru?
what does Sarah say? So that's what I'm going to. And
yes,
I will tell you the
The
reason why I
standard
will
that's
says
not
all
agree
that
I
with
have
you
to
don't
EY.
need
say.
to you don't need to do that. That's what that says.
No, I don't agree with you. I don't agree with you. The reason why I will say I don't agree with you, the only reason why I will agree with you is this. Does Dubai, did they use IFRS or US GAAP?
They use IFRS.
They use IFRS.
Yes.
Now, that's the first question I want to ask you. Depreciation rates, is it an accounting policy or not?
Depreciation rates
Yes.
is an
To determine
accounting
the
policy.
depreciation rate a depreciation method a company use or adopted, whether straight line or reducing balance method, is it an accounting policy or not?
It's an accounting policy.
Who determined the accounting policy? The firm.
The company determine accounting policy.
Thank you. Now, look at us. Can you see my screen now?
Yes.
The screen, yeah, we are saying that if a subsidiary use different accounting policy for like transaction and events in similar circumstances, appropriate adjustments are made to the financial statement in preparing consolidated financial statements. A subsidiary may have different accounting policy if what it does not prepare financial statements under IFRS, or prepare financial statements under IFRS but choose different treatment as permitted by IFRS. So the
So
only
so
scenario,
what you said now, it doesn't mean that they are right.
okay,
Because
let me
yes, number one, you said that does not prepare yes, which means you want us to align to the same accounting policy. But however, the group has agreed that they prefer their subsidiary to maintain because they have reasons, because they have different operations. The group has a different operation from the UK company. UK company, what they do is different, and they cannot decide to use their PPE in straight line. No, this is case by case basis, Mr. Badru.
it's a
Now,
case by
this
case
entity
basis. The
now,
question I want to
what they do,
ask now,
their depreciation rates it will not be straight line because of the way the asset is being used. I don't want to
let,
talk
let,
because it's recorded. I can
let-
pause the recording now and let me say some things. Let me
okay,
pause the recording.
let me ask this question. Is there a kind of a policy or a statement from the group to say we are fine
Yes,
with there's a
yes,
statement to that effect?
yes, from the
No,
group
that is
CFO.
no. Once there is statement to that effect, there's nothing to do about it. Now that has
That's what I'm
negated.
saying. Let me
That's
let me
number
pause
one.
this video. Let me
Number
pause it.
two,
Let me pause it and let me pour out my mind.
number two is that
Hold
because there
on.
is statement from the group,
Mr.
so the same thing is actually still applicable in UK. That when there's a conflict between IFRS and their local standard, because they did not scrap their own local standard, we in Nigeria decide to scrap our own local standard
Yes.
and adopt IFRS fully
Mm-hmm.
in Nigeria. But here, they did not scrap their own local standard. FRS 102 is still there. When there is conflict between FRS 102 and FRS 102 will prevail.
Previous. Okay. Okay.
So,
Okay. I get it.
in practice, yes, that means we are practicing here, FRS 102 will prevail. But as far as Nigeria is concerned, we don't know anything like accounting standard again. The only thing we know is IFRS. The only
Uh,
way,
Sorry, Mr. Badru. Sorry, sir. I'm sorry to
yeah,
come in again. According to based on what I explained, so if we are having IFRS and IFRS 102, if there's an issue within the two standard that loggerhead IFRS prevails. Oh,
IFRS prevail.
yes, but most times entities uses FRS 102. For example, if you go to company house, sir, and go and search company's account, I'm sure if you search 20 accounts, 20 of them will be FRS 102. You to be hard for you to find IFRS. Go and check, sir.
I'm just I'm company's house now.
Yes.
Company house better. Company's house better.
So just go to no, you're already there.
Yeah, yeah. There's one I used to use.
Click on down. Okay. No,
Company's
yes, no, that one gov.uk. Yes, gov.uk. Yeah, search. Just put in any name or something there.
Are these people strong?
I don't know. Okay, I'm strong Watson.
Yeah.
Um,
Are they top 10?
yeah, no. They are a small firm. They are in this Middlesbrough, around the Middlesbrough side. Oh, where are they? Okay, they're in Glasgow too.
Yeah, I know they're in Glasgow. Yeah.
Armstrong Watson, they're a small
I know
firm.
they have
The
all
standard they are
office
using.
address.
Will you say
It's a small
Consolidated?
firm within under 20 something or under 30. You just go to accounting policy. That will be under the notes 2 or 1 or there. But scroll down more. Keep going down under accounting policy. I think you must have passed it. Go up. You see accounting policy. Are you not there?
No, this is the auditor's
Oh,
report.
sorry. Go down. After the P&L, after all those accounts.
Not one.
Yes, after all these ones. After all these ones, you see accounting policy. Yes.
If not something
FRS
like
102.
FRS 102.
Go
Okay.
and check other accounts. I'm telling you, if you check 2020 will be FRS 102. Based on my experience. In fact, I have managers in audit in UK that they tell me don't mention IFI. They don't want to hear it.
Um,
You can go back and just check 1 or 2 businesses also in that same line of name. They will all be FRS 102. They don't use IFRS, but they impose it on Africa. Like Nigeria carry it on the head as if
this is a small company. Micro accounts.
it
Look
will
at
be
my.
FRS 102 also. Or even maybe FRS
Micro.
101.
It's just 3 pages.
Maybe FRS 101.
It's just 3 pages.
So I mean, I look at our debating, but it's also learning, no. That you get
Yes. Yes. I
because
understand.
it's an awareness because this is a practical class, not a theoretical class.
I know.
So
Which big company will I search? Barclay Bank.
Barclays will probably not be okay. Barclays might even be UK gap too. You'd be surprised too, but I believe Barclays might not be. Barclays might buy FRS because of their. But let's see because they are quoted, isn't it? So they will be. It's PLC. They are quoted, so it will be IFRS. They won't have a choice.
Cancellation of shares. Why? Purchase of own shares. Cancellation of shares.
No, in
Cancellation.
companies like Barclays, you find such regularly every year. In fact, you find like 50 every year, 100,
Change of
because
venue.
their shareholders will be relinquishing shares and they'll be buying more shareholders.
Purchase of own share.
You'll be finding it more in companies like Barclays. All these NatWest, Barclays, they'll have them, a lot of them every year. Why not just go to, let me show you shortcut to check, sir.
Where's the short of the chats?
Go to, click
I
on this confirmation statement or incorporation or account. Click on account.
account.
That box, yes.
Yeah, accounts. Yeah. 536 pages. Come
But
on.
it is IFRS. They have strategic reports.
Oh,
Other ones who have strategic reports.
536 pages,
You
man.
see, they have strategic reports if you check.
Is Barclays also in US.
I think so. Yes, they are in the US.
So there will be a lot of disclosure requirements.
Yes, and to be this thing to be IFRS.
Control find accounting policy.
It's not there. It's not there. It's not there.
It's not there.
Or not to account.
Not to accounts. Okay, not to accounts. It's not there.
We don't use the word "not to account."
Page
What we usually use
449.
is account.
449. See,
Part
by your
1,
right.
part 2, part
By your
3.
right.
By my
Extreme
right,
right.
right?
Down.
Extreme right. Is this
Extreme
my
right
right?
down.
Down. That
Mhm.
is
Not
Note to the financial statement. 449.
449. 449. I mean, your eyes is sharp. Oh.
I was going to say that Aminata is very sharp. Why not just use this cursor up, go to the side where you have 4/536. No, in the numbering by the side up.
Oh,
Yes,
okay.
type 449 there
449.
and hit enter. That's 448. Scroll down a bit, sir. That's
Okay.
it.
So
IFRS. I've seen it. These IFRS
okay, IFRS.
because it's PLC. It's quoted on the stock exchange. They have to use IFRS.
where did you see account?
Yeah.
See, yeah.
The consolidated financial statement of the group are prepared, and the separate financial statements of Barclays are also prepared. In accordance with international financial reporting standard.
They have no choice because it's public listed company. But anyone that is not PLC like this, I can assure
Does
you.
that mean? Because I'm surprised. Does that mean that any company that is not listed on the stock exchange is likely to tend to the IFRS 102, FRS 102?
Yes, likely. That's the word. Likely, not like all of them. I have a few of them that I audit that are IFRS, and that's because their group in another company compelled them. That's why. If not, they won't do it. They'll use UK GAAP. If they have a group outside that compel them, they will do it. They have no choice. But if not, they'll use UK GAAP. Strategic reports.
34, right?
Just type 38 because because of those ones will not be there. Mm-hmm. What they use? I think this one. I think this one. I think this one they use.
Adopted international accounting standard. UK adopted IAS.
I don't know what this means, but maybe I think it's IAS they use. Maybe it's IFRS.
This is your firm.
Which firm is this?
Your firm now.
Is this Azet or RSM?
Azeti.
Okay, then Azet will use IFRS now because Azet has business all around the different countries, so it's expected to use IFRS. So and they have business in different countries. So again,
there's opinion page. Let's search for opinion page again.
I just want to see where the businesses are.
Control find Azeti. Azeti is not there. Are you serious? That should be 24. Let me say 25 or 26. 25. Is it not Azeti? Yeah, it is now. Allen Brown.
No, we audited them. Now, I thought you said this is Azet account.
No, it's not a Z account. So
Okay, I was worried.
no,
Okay.
it's not. It's not a Z account.
So this company now probably has maybe companies, maybe like other group companies outside the country that's
Yeah,
compelled them to.
yeah, they do.
Yeah, exactly. If
They
not, they
don't
will
have
not.
other. They have subsidiary outside the country.
Yes. So if not, they will not prepare in IFRS. They don't want to prepare it.
So they have subsidiary outside. It's quoted as a PLC.
Mr. Badu, they must do IFRS now. Why, Mr. Badu, don't check any PLC fair. Check only non-PLCs.
My
PLC
issue
must
with
use
non-PLC,
IFRS.
my issue with non-PLC is that most of them usually file micro financial statements.
No,
Theirs use
even if it's not
very
micro, it will still be UK gap they'll use. Even if it's a big company, they will still use UK gap. Most of them, they don't want to use IFRS. They don't want it. I'm telling you, I
seven,
rarely audit IFRS in a year. Yeah, audit.
seven knock. The lumen seven knock.
Nobody likes IFRS in all these countries. It's only Nigeria that they just put it on Nigeria. Nigeria, you see them carry it on their head as if they even do as if UK is doing it too in Nigeria. They say UK one share, whereas they don't even do it in the UK.
Most of the
Probably it's just for comparison basis now. And most of the companies,
my
big
issue with
companies in
all
Nigeria,
this.
they
And
always have a branch. They
the
always
problem
have
with no
a
the I mean like, the
company
problem is that
outside the
this
country for comparison basis.
no I'm like the problem is that this
Yeah.
So, but I mean, no, for Nigeria, not. I don't think we
Mm-hmm.
should have this issue. Most of the company in Nigeria will
Okay.
use IFRS. There's no
Okay. Yeah.
basically.
Yeah, but in a
But apart from
situation
that,
where they are
okay, I'm
doing a
listening.
consolidation
Yeah.
and probably I'm consolidating for a branch in another country that is using UK gap, right? And with a company in Nigeria that's using IFRS. Mm? So if there is a change, if there is a different accounting policy, no need to allow the other one using UK gap to trying to now recompute this on IFRS, Abi.
But basically, that's what I'm trying to say. That in UK use IFRS as well too. So the reporting should be IFRS. So if the company is
Okay,
likely to tend to FRS 102, now the
okay,
issue is just this: by default, FRS 102 and IFRS are almost the same. They are almost 70% the same. Let me use that 70% the same, but there is 30% divergence
okay,
in some standards.
okay,
So what it means is that if the treatment in certain item is not in line with IFRS, and what it means is that IFRS is more likely to be more detailed in reporting that item than FRS 102. FRS 102 is likely to not go into deep to say this is what it is. This we should follow this procedure, we should follow this step in line with IFRS. But FRS 102 is likely to go less, there should be more length in that treatment. So the question is that because you are reporting internationally, you are not actually looking at your orders to be just limited to UK, use IFRS, and the changes should be in line with IFRS.
okay, that's fine.
All right. So we said that the difference in accounting policy may also be choosing for tax reason or legislation in its country. We have entity B and we have entity A. Entity A carries its land and building at revalue amount. Entity B carries that and building at cost, less depreciation and impairment losses. As entity B is consolidated, the carrying amount of the land and building will need to be what? Restated to the fair value to align with the group accounting policy. Note, there will always be a deferred tax impact arising from that what? Adjustment. Generally, there will be a deferred tax impact arising from the adjustment. So this kind of thing will happen if both of them use they use the same standard, IFRS. But if they are using different standard, there's no need for you to what? There's no need for you to adjust. Are you making sense?
So, yeah, sorry, Moses, have you started recording again?
yes I'm recording, but I just pray it's even picking the voice, so
Yeah.
I pray it's picking the
Not yet,
voice.
oh. Please let us check. Thank you.
Mhm.
Can we continue, please?
Yes, sir.
Yeah. So so that is that. So basically, understanding the fact that there may be change in reporting date, there may be change, there might be difference in reporting date, there may be difference in there may be difference. And I told you the last time that I'm going to show you how consolidation actually happened. And I told you that in reality of it, consolidation is just you adding line item by line item, but where necessary, adjustment to be made. And source of those adjustments is when you have to change accounting policy. If there is no need for changes in accounting policy, if there is no need for changes in reporting dates, there is no need for adjustments, basically, and there won't be changes, and there won't be need for changes in there won't be need for adjustments, technically to say, if there's no difference between how certain item is being treated, which lies down on the accounting policy of the two different entities, the holding company and the subsidiary. If there is no that difference there, then you are not likely to have so much difference. But don't forget, like you just asked now, Abino, that you have a group company in Nigeria, you have a subsidiary in UK, and you want to report the group. Don't forget that. Don't let me even ask us a question. What will be your reporting currency? The group is in Nigeria, the subsidiary is in UK. What will be your reporting currency?
It should be naira.
The group.
Naira.
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 I
At
can't try.
what? Naira. So,
Sorry.
what will be your conversion? How do you derive your exchange rate of
You will
converting
use
the pounds? How do you derive your exchange rate in converting that pounds to naira?
there are two ways.
Okay.
You might be given the conversion rate
No, you are
in the
not. You are
question.
practicality. We are not here now. We are not talking about exam. We
Okay,
are talking about practicality.
practicality.
Yes, you
You
are.
could
You are the
use
group.
the
Let me say, for
exchange
example.
rate.
Okay,
Sir,
continue.
you could use the exchange rate as at the date of your reporting date.
Where will you get it?
You have to get it from,
CBN rates.
I don't know.
The approved CBN
Maybe
rates.
you can't use CBN rate. Ṣó fẹ́ parẹ́ ni. You use the
Approved
market,
CBN
open
rate.
market rate.
No. Open market rate is not acceptable. You have to use
You have to use the
the
open
commonly
market rate. Ìyá, ó
I
available.
fẹ́
think what
lọ
Mr.
lo
Bradley is
ó
asking.
fẹ́ lọ lo
The question I'm asking,
I think what
do
Mr.
you
Bradley is
get my
asking. You
question?
guys are now answering that question. He's
My
asking.
question I'm asking is that I have my
I know
question
where he's
is
going to.
No,
my
she's
question
correct now.
is
She has answered you. She said
No, that's not what.
you
That's not the
get it
question he's
as at
asking
the
you guys.
reporting date.
my question is the reason why I'm going to that question is because there can be the two entity can be using the same accounting policy, but there can be also need for you to have adjustments, right? And I was asking because you said the company is in Nigeria, group company, the parent company is in Nigeria. Let me use the word parent company, and the subsidiary is in. There was one subsidiary in UK. There's one subsidiary in Ghana, and the parent company is in Nigeria. So how will you convert the separate financial statement of the UK and the Ghana to naira? What rate are you going to use? Where are you going to get your rate from? Does that make sense? Two questions.
Can
What
I
rate are you
answer?
going to use? Where are you going to get your rate from?
Should I let other people answer?
I do want to answer. They have answered the question partially before.
So the P and L will be. You have to derive the P and L rates using the average exchange rates throughout the year. So which means you have to compile the rates from you have to use the CBN rates because that's the rates that we recognize in Nigeria, the CBN published rates, because the Nigeria is the parent company. So you have to now put the 12 rates in the year, then average it for the P&L. Then what for the balance sheet, that's to be at the reporting date. You have to
Reporting
translate at the reporting date, which is the year-end date for the balance sheet. Then the same will apply to the Ghana company and the British company. They have to use the CBN published rates. I understand you might be looking at the purpose of the Nigeria instability in terms of the currency and the CBN rates being very diverse, far from the mainstream Aboki rates. But however, it is what it is.
Yeah, I think that's an answer Sandra question. You can't use the parallel market trades. You can only use the CBN rate, because even what if you need to make adjustment maybe 5 years backward? Are you going to go to
Sir, I beg to disagree. I was in a
yeah,
panel with the CBN of recent,
yeah,
and they stated it themselves that it got to a point whereby they were not giving FX. And then they told the market to go and source for the FX themselves. Now, in that particular year, when people are forced to source for the money themselves,
yep,
now the what is actually going on in the public is that there is an I and E rate. There's the CBN rate, fine and good. But these guys still come to the back to take the second leg. Are you saying I should just chop all the whole cost
Can I
and
answer, Mr. Badru?
okay, you can answer, but maybe I want to answer too, but you
Please
can go ahead and
let her
answer.
finish. Let her finish now. Shall not finish.
Okay.
Sandra,
so in
continue.
that
Sandra.
in that situation now, are you saying that I should go and use CBN rate when it is CBN themselves that stated that everybody should go and look for the money themselves and clear all their liabilities? Are you saying that when now reporting my financial report, I should not take cognizance of all the whole other rates that was attached to it, irrespective of the fact that the CBN is quoting so and so in preparing my reporting? That's my question.
Okay, so the first thing I wanted to answer, I will say is this. You've gone to the black market, right, to go and source for fund, even though CBN is not providing fund, right? Now, so CBN, because CBN issue a statement, is there CBN does whether CBN even issue a statement that we don't have fund available or fund is available, right? The standard itself, accounting standard itself, provide way of reporting that is I want to use this word. Will I use the word verifiable, right? The reason I'm using the word verifiable is because if you are using the black market rates, what their rates at which Aboki in Ojolegba will sell is not the rate Aboki in CMS will sell. Oh. They will sell at different rates. That's number one. There's nowhere a track of record. If you want to go back, let's say you have reported this thing, you are reported you are reporting 2023 transaction financial statement. We're now in 2025, and you need to make an adjustment backward. Is there anywhere you can go to and say this is a bookie rate as at that time? I don't think there is. But if as at today, as we speak now, we want to know what even those period when that CBN told them that go and source for your fund, right, from the black market. If you go to that period when even CBN make a statement and go to CBN portal and search exchange rate as at that particular date, CBN will see publish a rate. Because CBN is not making FS available, that does not mean that they will not publish a rate on a daily basis. They will still tell you how much their rate is as at that particular day, even though they are not making that fund available. That's number one. It is always there. A black market, I'm not likely to see it. Though I won't know whether that is a black market or it's not a black market trade. Oando rate, there are some rate that we definitely could check. But I think Oando rate is almost very close to to CBN rates for as far as I'm concerned. I won't say it's a black market trade. Whether it's a black market, I won't say yes or no because I can't actually give you that fact. But I'm telling you that number one, there is a rate on CBN at that period, even when CBN is telling you no FS is available. Go and source for your fund. Number two, in the face of the financial statements, there is foreign exchange loss or gain now. Don't you have foreign
Okay.
exchange loss or gain?
Okay, so that is where the whole excess money that you have incurred will go to, because that's actually what I am
That is
looking at.
if that's the first thing I'm supposed to say, but I'm just that's the first thing. Like there's foreign exchange loss or gain.
Okay,
Can
that's
I
fine.
contribute, sir, when you're done, sir?
Yeah, so that is just it. There's only there's exchange loss or gain. That's number one. Number two is that I don't know what other company use, but this is what me I use in UK here, right? In UK here, I want to remember there's HMRC portal. I think I use HMRC portal. HMRC, I think HMRC exchange rates. Right. Thank you. I think it's this. Yeah. So can you see my screen, right? Can you see my screen? Can you all see my
Yes, sir.
screen?
Yes, sir.
Yes,
Yeah.
we can see it.
So for me, if I'm using an exchange rate, monthly exchange rate, this is where I come to. If you go to this monthly exchange rate, I even come to, you can see it is monthly. You can see November, December, January, whatever. That was what Moses was saying last time, that for POL item you average it. So let's say, for example, I'm looking at monthly exchange rate. I just want to view it online, right? You can see for different country, Dubai, Albania, Algeria, even up to Nigeria. You see every country is there. So if my subsidiary is in Nigeria and my holding is the group company is this parent company is in UK, I'll come and look for what is the exchange rate for Nigeria. See, can you see the rates? This is HMRC rates. So this is the rate as at for pure L item. That means I need to accumulate each of these rates for each of those months, then average for pure L item. That does not mean that how are you very sure that even UK government is making FS available or something? That does not concern UK. You're looking at where can I go to verify. If I go as far back as this, I just picked 2025. If I go as far back, I will see 2021. I can always pick that figure. As far as 2021, I can always pick that figure. So the same thing is applicable to CBN rates. You can always go back and pick. You can see December 2021, November, January. But is there anywhere in Aboki that you cannot pick? So this basically for UK transaction, basically this is what I use, because even there are some company in UK that have transaction in Hong Kong, China, different part of it, and they need to consolidate the activities. This is where they come to. They won't tell you that because maybe Hong Kong government is not providing funding or whatever. Though for me, I basically does not think it's making sense. So the same thing with going back to the CBN rate to say, I go back to the CBN portal, I pick a rate, average it for my POL item, for my balance sheet item, I look at the reporting date figure. I think that is that is my take. So I won't know why CBN is saying, where CBN can say go and find your fund, but they are not advising you how to report it. The advice, because CBN said go and source for your fund, does not mean that does not amount to how you should report it in your book. I don't think that reports to that, as far as I'm concerned. So that's my take on that, though.
Just a quick addition to what Mr. Badra said. Mr. Badra has actually nailed it. So, but the one thing I want us to just look at is that, accounting is about reliability and consistency. So now, if we are looking at the aspect of rates, and then we can decide to distort the account using rates. I do hope you know that, Sandra. For example, if a bookie is selling pounds to naira for, let's say, 2,300 naira for £1, and then other book is selling for 2,100, we can bring in an imaginary rate and say that the pounds was sold for 2,500, and then put that on the account. That alone would distort the figure of the account, and then the financial statement becomes unreliable for that purpose. So for the purpose of reliability, consistency, and then comparability, because if you look at it, if you are comparing from this year and last year's financials, the fact that CBN didn't give you figures, didn't give you the currency, doesn't mean that there's not an exchange rate. And I'm sure that thing that you said CBN even said was probably said verbally. It was never written down. Because I strongly believe that CBN will not write down that everybody go and get your rates. That becomes jungle, what's it
No,
called?
no, 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 no.
But
What they
actually,
were
it's on the
actually
news.
trying to do was that what they were actually trying to do, you know very well where I'm coming from.
I
I
know,
would
I'm
not
coming
want
there.
to talk
I'm coming there.
extensively. Yeah, I may not want to talk extensively on the
I know.
matter,
I'm coming
but
there. I'm
they
coming
said
there.
it, and then they brought a circular to that effect.
Okay.
Well, they were not speaking to me directly, but they were speaking to the bank directly. So that's why I'm like, in such instances, you've already answered my question. So definitely, if we are to make use of the CBN rate, then we have to every other thing that's transpired within that period has to go as
Yes.
exchange
Also, if you don't
rates.
want to use the CBI, if you think it's not consistent enough, do you know you can actually use the O and D rate, like Mr. Badu said.
Yes,
You can
Wando rate.
even use the HMRC portal rates in
Yeah.
Nigeria, as long as you're able to prove and demonstrate O and D,
Sir,
O and
sir,
A.
you know the volatility of FX these days is crazy.
Yes, the fact that you bought
We
from
have
black
gone
market
from I
is
and E.
so
We
the
have
fact that
gone
you
from I and E rates. We have gone from I and E rates. We have gone from I and E rates. Now we are in B match.
yes.
The current one that is reigning now is B match. So
So
these things they just keep changing like that, and they are all policies that are raised by the regulators,
yeah, yeah.
and they differ from what the regulators are putting on their portal. That's actually the point
Hey,
I was trying to
Mr.
buttress.
Man.
But you've already said the way it should be reported.
Yes, yes. You know, most of this is government's inconsistency, but at the same time, as well.
So I'm just looking at what Wando rate quotes as at today. Today is 8, right? Wando rate quotes 1886. And I want to see what HMRC rates. My this my supervisor use one rate, but it's not
Me, I only
HMRC.
use O and D all the time. I never even use HMRC. It's O and D I use for all my work.
So um this is November view. Okay, this would be like Nigeria, right? Did I use Nigeria? Yeah. Men OPQ MNOPQ M
It's not 19. Yeah, 1952.
1925, I think. But this is for the month, average for the month. But O and D can always tell you as at a particular day, individual day, you see the date changing. So, but HMRC will always use end of the month. But basically, in accounting, when you are reporting, you're actually reporting at the end of the month. So that's why me, I go to and pick end of the month um in HMRC. Me, I always use HMRC sharp.
It's about
But
it. So, like what I usually do, I don't know my own. I usually pick O and D. I'll pick for the whole 30 days in the month and I'll average it myself
yeah, the same
because
thing
O
also
and D
applies.
gives O and D gives every day.
Oh,
So I'm just looking at maybe I don't know. Well,
okay. You pick the whole of the month and you average it.
yes, 30 days. You can download an Excel on O and D.
Yes, I know, I know,
So
I
you
know.
just average it
It's also
straight.
available in Excel as well.
Yes, yes.
It's also available in Excel. Really, I never thought about, but yeah, yeah. Um, Basically, I think that is just it, though. So when you are converting for Nigeria, I think you should use CBN rates. Every other country should use applicable. I know a lot of companies will have applicable rate they use on the website like that. Different country, maybe US should have they should have a rate they should use. So going by that, where you can have an issue when it comes to consolidation is when either changes in accounting policy and you need to make adjustments. If there are no changes in accounting policy, is there no changes in reporting dates, consolidation is usually very, very easy. And like I've said, I've always said that consolidation is about adding. You are adding A to B to C to D. And I'm going to show you basically how it is, right? So look, in this scenario, don't mind the other one. Those ones are just for I think I will hide this. I will hide this. Control O. Come on, no. So This is UK operation in terms of revenue. Another operation in another country, Germany. Another operation in Russia. Everything give them the total sales. Staff costs for UK, staff costs for every other entity. Everything boils down here, right? And so on. That's how you can use to add line item by line item. That's how you can. That's how you can use to add line items. So when it comes to your statement of financial position, you can see UK, the fixed assets, Germany, Russia, another German operation, adjustments. Now, this is where the adjustment comes from. This adjustment can either come from either revaluation or some other adjustment that must have happened. You can see that adjustment is coming here as under adjustment, and you have your consolidated financial statement. And I tell you the reason why there can be adjustment. Adjustment can come either in form of, let's say, there is difference in accounting policy, there's difference in maybe valuation model, or something must have happened. That is when you can have that adjustment. So the same thing with your current assets. You can see add. It's all about addition. Anytime you have adjustment on the actual face of the financial statement, this is just the working. On the actual face of the financial statement, you're likely to see in the notes individual, or you are seeing to say the parent, subsidiary, and you have the group. And you can see here in this scenario, this is the parent company, and this is this one's 1, 2, 1, 2, 3, 4. They are 1, 2, 3, 4. Like I told you, this Russia has more operation under it. It's not just Russia. That's why they put UK and Russia. They have more operation under this Russia. So you can see this is a subsidiary, this is a subsidiary, this is a subsidiary, and adjustment is coming here. There are basically two companies in Germany. This one in Germany, this is another company in Germany that they have acquired. And this is also operation in UK and Russia that contain Italy, France. All these figures that are seen here in the original financial statement are reported in their currency, euro. So these figures that you are seeing here has been converted. Basically, what I've used to convert here is to use HMRC. I didn't even think of Oando. I know I use Oando for personal thing. I've not actually think of using Oando for reporting. I always go to HMRC and look at the end of the month. What's the exchange rate? Then convert it. So that's how you can use to add line item by line item. Like I've told you, consolidation is all about adding. You are adding figures. You're adding figures. You're adding figures. So this particular page you are seeing here is the workings page, right? Let me see.
The ordinary share capital.
Ordinary share capital, yes. What happened?
There are some figures there for the month, right?
I'm coming. 12. Okay, yeah. You don't actually need this though. So see, when I'm preparing management accounts, personally, because it's a group, I'm always putting a note of what actually happened. You don't need this one though, where you might need this if it's the internal. I'm always telling the management what actually happened, what are brought about changes in operation. So at a glance, this is my final result. So at a glance, I can only tell you, okay, the brand experience department performed poorly against forecast, because there's actually a forecast. You can see here, you are seeing actual results, you are seeing budget, you are seeing forecast. I'm actually comparing that one with what actually happened last year. So what happened last year to what happened this year against budget, forecasts, and all the stuff. So I'm telling you, this is what the company actually achieved. And this is what we budgeted. This is what we forecasted. You might not actually need this result in actual sense of it. But I'm always putting notes to say what actually changed, what are the changes to see, because that is what management actually wanted to see. Management doesn't want to see if they said there is meeting after the meeting, right? Management doesn't want to. A lot of management does not understand the whole of the financial statement that will give them, because there are a lot of disclosure there, and they don't want to go through that disclosure requirements to say this is what happened, this is what is happening. They just want to see something at the top level summarizing for them, and one way or the other they know that that thing is happening, because before anything take place, management are involved in meetings. They know there are these activities, but they won't know how it's going to be impacted on the financial statement, right? So the impact on the financial statement, at the end of the day, you need to tell them why this thing is higher. You can say, yeah, I'm saying that UK costs were 167,000 higher than forecast, and I need to tell them why it is higher, because there are higher bonuses and commissions, because that means people are meeting their performance bonuses. And this is what happened. German cost was also 7,000 higher, lower. I'm telling them why is it lower. Okay, if you are budgeted, you are going to pay this amount of money, and we pay lower. Why is it low? Why is it lower? You must actually tell management, because those are the things the management really wanted to see. So, in a nutshell, this is how the group activity is being actually reported. You see them line item by line item by line item by line item by line item. So Amina, let me go back to your question. So you are saying something. You're saying something, Amina.
Yes, I was seeing that this ordinary share capital. I'm seeing
Yes,
value
that's why I
added.
put
Was
it
it
there. Yeah.
also consolidated?
What did you say?
Was it also added together under that group?
So yeah, I have for the UK, I have for the German, I have for the German is one. There's an adjustment. So it wouldn't have been consolidated because adjustment has went through here. That is why, but as a unit, in the whole of the group, is not showing, but as a unit is showing, because something must have happened here. I think what must have happened in this scenario
Okay.
is that there's a transfer of equity. There's a kind of agreement that went through in between during the year. That's why there's adjustments on that equity, and that's why it's showing that adjustment on the
Okay.
face.
Okay. Now I get.
But
Okay.
on the group is not actually, it won't be showing on the group financial statements. And that's the same thing you do for your cash flow to get what total. So it's all about adding. It's all about adding. Don't forget, you can see that me, I'm showing you this adjustment, right? The reason why you are showing this adjustment on the norms is because this is a working paper. On the total financial statement, this adjustment should either be showing in your note to the financial statement. This adjustment should generally be showing in your note to the financial statement. But on what I'm trying to tell you is that when it comes to consolidation, the majority of the work in financial statement has been done under your separate financial statements. Majority of consolidation work has been done under your preparation of separate financial statement. So if you have actually complied with a lot of rules, accounting policy, standard in preparing your financial statement, when it comes to consolidation is very, very easy, because we are just adding. Where there can be complication is a case where there is difference in accounting policy or there is difference in reporting dates. If there is no difference in accounting policy, there is no difference in reporting date, your consolidation is one of the easiest things for you to do, because you are adding item by line item. And I told you that consolidation, even as standard has said it, when it comes to consolidation, it's just adding line item by line item, line item by line item. And basically that is basically what we are doing. Like I've said, all this note that you see here, please ignore, because is an internal decision making note, just saying this what happened. There is favorable something is actually happening, variable, to tell management that okay, yes, this is what we intend to do, or this is what we have as per budget, and this is what we have as per forecast. Because on the norms, not everything will applicable to certain company. Some companies are bigger enough to say they want to have a monthly budget, and they are comparing their budget to what they actually achieve. And they also have what they said they forecasted to achieve, because that is what they use to measure certain department performance. Let's say people in marketing, sales. If the company say our budgeted revenue for the month of November is, let's say, 3 million or 100 million, and they are telling the sales, what they are telling invariably to the sales department is that if you're able to eat this particular amount of revenue, you get this bonus. If you eat more, you get a particular bonus against their actual. So those are the things they use to measure these people performance. Apart from that, that is also what organization want to use to measure their as well, to say, okay, if we intend to do this, you can see in this month now, there's a big variance between what they actually budgeted and what they forecasted. Because in this month of December, what they budgeted was 60,000, what they actually achieved was 60,000, but budget and forecast was saying 171, 160. So you can see there is a big gap between the two. So basically, that is what
Sorry to have this small question. This
yeah.
question.
Can you move
So
closer to
the
the mic a
difference
little
between
bit, please?
okay. Can you hear me now?
Better, very better.
Okay. So the difference, what's the difference between this budget and forecast? Is it that forecast is done maybe at the beginning of the month and budget is what they've done for the whole year, right? I'm just trying to look for like I don't know budget forecast. It's not the same thing.
Okay, so me in my role
I
preparing
know
budget.
what to say. I mean, now why are you asking this kind of question? But seriously, it's really confusing to me.
Okay, me in my role, right? I do budget and I do forecast, right? And I don't do it on a annually basis. It is done on a monthly basis, right? And this I will tell you the criteria for doing the forecast. I will tell you about the forecast first. I know what we have done in 2024, right? I know what the company has done in 2024. So based on the 2024, I will use it to forecast for 2025. Are you making sense? I know what they did in 2024. Based on 2024 operation, I will use that to forecast for 2025 operation. And when I'm forecasting for that 2025 operation, I'm looking at to say putting variability of inflation inside, right? I put a lot of economic scenario. Let me use that word, economic scenario. I put it into my forecast. But when it comes to my budget, I do not only put economic scenario into my budget, I also put commercial scenario into my budget. When I say commercial scenario, are we also signing a deal in the next few months that we did not sign last year? Are we talking to, is the company talking to new clients? Are we trying to acquire more businesses? Those are commercial. The economic environment does not affect it. So, but when it comes to my forecast, I look at what I can say, yes, last year we did this, but this year, I think even if we go by 10%, then inflation will affect it. This is what is going to happen. Economic scenario, economic activities is the impact on the businesses. Legal aspect of it, economic. Are there changes in law? How is it going to impact on the business? But when I'm looking at my budget, it doesn't look at it. So in most cases, I don't actually make a lot of decision based on the forecast. I make decision based on budget versus. I usually do budget versus forecast as a kind of comparison, but I do actual versus budget because this
Now I get
budget is what is communicated to other units to say this is your budgeted target for the month, but this is not a forecasted budget for the month. Forecasted target for the month is a forecasted for like it goes beyond to say whatever. But I tell them you budgeted to achieve these targets, but this is what you achieve. So when making decision, when actually seeing whether the whatever, I use these variances. But that doesn't mean like I can't actually also use variances for other things. It's okay. Our budget for the forecast, you can see here budgets. You can see here variance. You can even see here. I'm saying the group operating profits versus what forecast. I will know somewhere I will still have my actual budget. What is the how did you achieve? But that is just the I don't know whether that answer your question. So a lot of companies does not do forecast, so or they only have budget. But my scenario, I do forecast, I do budget. But in my forecast, I put into scenario inflation rate and another thing into last year operation. But this based on are we signing new deals? What is the growth? Definitely, and I also look at to say in certain period there are likely to be more sales to that. That what will determine actually what my budget is going to look like. Does that make sense?
yes, it's fine.
Okay. Can I sorry, I wanted to ask the last part that I'm taking, which is disclosure on set of accounts. Did I agree that I'm going to take it today or tomorrow? Moses, please. Hello? Hello, Moses.
I don't think it's with his maybe phone or something. It's not closer.
Let me even, can I go
I'm
to,
not sure. I think you are taking it today while he's taking preparation of financial statement tomorrow, but I'm not sure.
thank
I
you.
think our
So,
disclosure is today because of you said we are behind already.
yes. So, do you want me to give you some minute break or you want me to continue?
Sir, you can continue now. I don't know about others. You can continue, but sir, you need to share your slides. So I've not seen any of your own slides since we
Okay,
started.
you get my slides, all my slides today.
Sabado, thank you. I just want to ask everybody. I don't know if if everyone is if you can you still go on.
Okay. So,
I don't know if Sabado, are you not tired or something? Can every
no, no,
also
no, 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 no,
okay?
no. I'm good. I'm good to go. If once, as long
Okay,
as they are good to go. So the last part,
okay, sir. Thank
that I'm supposed to take, right, is full set of disclosure in a financial statement. So I know my guy is going to show you how to prepare financial statement, but me, I'm not going to go through that. So okay, um okay, let me just, I will show you this practically. I can send you sample, right, with no name, a blank sample, but I'll show you practically, right? I think so. I'm not sure. Okay. Okay. Good. Good. Okay. Fine. Can you see my screen, right? Can you see my screen? Can you see my screen,
Yes, we
please?
can. Yes, we can.
So, so this is the way I want to explain it. There's a thing to say I'm preparing a financial statement. Preparing your financial statement. See, what I've shown us here, right, is just showing this. I just forget about all these ones. So this one are just showing figures, right? They are just showing figures and commentary notes. Commentary notes is just for decision making. Figures, figures, figures. Some of these figures are feeding from this particular sheet. Is linked to this particular sheet because this is my work paper. There are a lot of things I've hidden in this financial, in this whatever. It's more than this 3 page. I think it's more than 3 sheets. I think it's about 13 sheets. But where I'm going to is that these are the final results, right? These are my final results. These are my final results, right? But you, as either an auditor, I'm not sure whether as an accountant you are required to do that. And I'm not sure whether there is a software in Nigeria for internal person. Even when you use those, I don't think so. I don't like, I'm not sure. Whether you use Sage, you use QuickBook, you use Ali, you use Pando, Odo, Zero, any of software.
Well,
All those software, by the time you put into your accounting system, right? If at any point in time you want to generate a report, the report will only give you your income statements, your statement of financial statements, financial position, and your cash flow equity statements. I think that is what I know. It's not like I think. Don't pardon my language, Joe. In UK, if you say I think, you are saying that is what it is. That I'm getting used to that. I think so. I think it will give you that. It's only going to give you that report. It's not like I think. It's going to give you those things in figure without a note. But according to accounting standard says that financial statement comprises of the following: statement of profit or loss, your balance sheet, your cash flow statement, changes in equity. But there are some other things that was mentioned in IFRS, which include statement of directors' responsibility, auditor's opinion page, and notes to the accounts. So that means, apart from having your working paper, following accounting standard to prepare all those figures, and your figures is right, you have seen your profit and loss, you have seen your statement of financial position, you have seen your statement of changes in equity, you have seen your statement of cash flow. There are some other things that people want to look at, that when they look at it, they don't need to, how will I put it? I think my boss used to tell me that your financial statement should be able to speak for you when you present it. That means people without seeing you, they should be able to interpret your financial statement. And what will make them to interpret your financial statement is your other disclosure you have put in the financial statement. And some of the other disclosure you need to put in the financial statement is basically responsibility of the directors. There is no how will I put it? There is no standard format for responsibility of directors, but it must contain certain things that the directors are the one responsible for preparing the financial statements as part of your audited financial statement. That means you are making the director liable that the financial statement is being prepared by them. But I will tell you what can be applicable in different scenario, right? Different scenario where I will say that different scenario is because I will use Nigeria as a case or a scenario. In Nigeria, we have some big companies, we have some medium-sized company, and we have some, I will call it Papa Jasco and Co, small company. And I want to see us in this class or in this conversation. I don't want us to see yourself as being just a regular accountant. I want you to see yourself as a consultant. And as a consultant, um, you are thinking to say, I want to be on my own, right? Basically, you are like, I want to be, because I don't want to continue to work for people. So a lot of people that get into consultation start very, very small, right? Like this company, I'm just showing you. This company, basically, when I joined them, they were giving me 1.5 million. And some of my friends was telling me, why will you collect 1.5 from this company, even though this company was doing billion? But now I collect 5.6 from this company annually, just from preparing financial statement. Does not include any other service. If I render other service, if they have any issue with tax authority and they call me, at the end of the day, I will send my bill to them. So I'm looking at it from the SME part. And why I have to go to that SME part is that you will get some clients that there is nothing they are going to give you on apart from what my guy have told you the last time, bank statements, right? They are giving you bank statements. But I'm just saying, is this thing recorded? Well, I'm not saying anything
Yes,
that,
so it is. Oh,
It's recording.
okay, continue recording. I'm not saying anything that is bad though. We are actually
yes,
seeing,
now. Yeah,
yeah.
yeah.
So basically there are some clients that when when you get
But
them, the only thing that,
is it not your client? I think we should not record it though.
no, don't worry, continue, don't worry.
Okay.
So there are some clients that you will get that the only thing they will give you is just for you to is bank statements, right? When they give you bank statement, that means you are the one that will prepare their account from this trash. Invariably, do you know that your responsibility has gone from preparing audited financial statement? Your responsibility has gone from preparing financial statements to audited financial statements. Because what this thing is saying is that this particular note or disclosure is saying that the financial statements are prepared in accordance with international financial reporting standard, and the director are particularly responsible for the what internal control system. But in that scenario, if you have a client that does not have any accounting system and the only thing that they gave you is just bank statements, indirectly you are the one responsible for preparing the financial statements, because there's a difference between financial statement and audited financial statements. Do you agree? Because when you go to, let's say, Sage or QuickBook or Zero or Pando and you generate a report there, that report is the financial statement. Some people will call it management accounts, but that's the financial statement. It's not audited. It is when it has undergone audits that when it becomes a financial statement. So in that scenario, you are the one that will now start doing your analysis, analyzing your revenue, analyzing your expenses, create a trial balance, and create a report, audited financial statement. But the question is that when you are preparing the audit, when you actually finalize the audit, will you still put it there that it is you that is responsible for preparing financial statement and maintaining internal control? No. You still have to have this statement making the directors liable that they are the one responsible for preparing the financial statement, even though in that scenario, in that very, very, very small SME that has only give you just the bank statement, you are still making them liable. So if anything happens and they are saying that what is wrong, this financial statement is not right, you are telling them you are prepared based on the information made available to you. And the information they are making available to you is what? Is the bank statement. So as part of full disclosure to the financial statement, the standard requires us that we have what we call responsibility of the directors. So this is what a sample of responsibility of the directors look like. This is a sample of what a responsibility of the directors look like. I'm saying that I'm looking at it in the context of Nigerian environment in this scenario. This is a sample of what responsibility of directors look like. I'm also telling you that it is not just statics. As long as it contains the required information, does not mean that it has to be in this particular format. Then another thing you also should have is what we call the director's report. So you must also have what we call the director's report in the financial statement as part of the financial statement. How you form your director's report, we have to do with a lot of things, and some of them also have to do with information from the incorporation documents. The last time I mentioned about adding what we call a ceteris audit, and you can see in this scenario, you can see director's interest in shares. It was mentioned here that these are the director's interest in shares as at the end of this year. This figure can change from year to year. If I go back to this company in 2024, this is not the share composition. They have changed the share composition because some of the directors have left and some of the directors have came in, and some of them have to relinquish their share because they are leaving. So as part of that, as part of forming your director's report or even forming your note to the account, you might need to refer to incorporation document to see if there are changes in what? In even operation or any other thing. Share composition, shareholder units, and all the stuff. You must actually check to see whether there are what? There are changes in operational arm, whether they have also had another thing, whether they have acquired some whatever. So that is what you have on your director's report. And like I was saying, this is not like just statics. Every company have to be dynamics about that. But as long as it's containing as much as relevant information that is applicable, we are talking about the incorporation of the company, we are talking about the nature of the business of the company, you are talking about review of the financial results, you are talking about the director's interest in shares, you are talking about insurance and risk management.
I'm hungry. I'm hungry.
You are talking about the interest, training and development. You are talking about health and safety, litigation. You are talking about going concern about the company. You are talking about the date of preparation of the financial statements. So that is part of disclosure requirement that is required. It does not stop there. It also goes down to the what? Accounting policy. You can see when we are reviewing financial statement the last time, what were we checking? We are saying let's go to the accounting policy, right? Not to the accounts, not to the financial statement. We are saying let's go to the note to the, because that is basically where you will see some other information about figures. Because financial is not about figures only, it's also about note to the accounts. So we are like, what is note to the account? What did they say here? What did they say here? Because you are not actually looking at the figures. Those are those are disclosure requirements. So you can see here, we also come to the note of the account to say what is the capital accounting policy. Basis of preparation, we have told them is in line with IFRS. We are talk about what the revenue, how revenue is being accounted for. And we told them that revenue from contract, how it is being accounted for. We actually stated it. You need to tell them what basis we have used. So I also go back to protest that point, that when we are having that discussion the last time about whether there should be adjustment to Dubai operation or there should not be adjustment to Dubai operation based on what AI have done. It is under this note to the account you will see, or there can be a statement from the group saying that it was a statement to say we should do this. You can also find those information on your note to the account, because the more information you provide, the more a third party looking at your financial statement is able to interpret. And one of the things I also like about this is that anytime I submit a financial statement to the tax authority, especially in Nigeria, if they ask me certain question or they query that account, I'll just look at why are you querying that account, because the first thing I'm going to go and check is that did I disclose it? Like, did I disclose it? So if it's something I've disclosed, the first thing I would do, like, I would just my reply to that letter will just say, can you refer to no so of my financial statements? And I will not say more, which was properly disclosed. Because I'm telling you in that note, I'm not telling you to look at the figure. Maybe you're asking me information about a particular item in the financial statements, maybe profit or loss or balance sheet, and you're telling me, give me the breakdown of this or explain this to me. I'll first of all look at it that did I actually disclose as part of the note to the account? So as part of the note to the account, I expect you to go there and check. Not that don't just look at the figure and say, give me this one. I want to tell you to go to the note to the account, because the note to the account is being interpreted alongside with your financial statement. You don't just look at the figures only. So you can see, we talk about the revenue from contracts, you talk about financial obligation, evaluation, you talk about cost of sales, how it's being done, you talk about the profit and PPE, what is your depreciation rate that you have used for this company, how many years expected to last. That's where you discuss it. You talk about your trade and receivables. You talk about your payables. You call that cash and cash equivalents. You talk about your tax. That's where also you discuss about your your deferred tax asset or deferred tax liability, if it is actually applicable to them. So that you talk about your tax expenses. You talk about your share capital. This is where these are part of the disclosure requirements that is required by IFRS. So what it means is that you as a consultant, I will not see you as an accountant. You as a consultant dealing with whatever, these are the things that you must also add. In addition to the financial statement, you must also add that when a third party that have not seen you is looking at your financial statement, we also see. Now, you can see that most of these notes to the account, some of them are quantitative, right? Here, this is not exclusive. It might also include you to have this is what I have it. Okay, thank you. See, you can see, look at this now. These are just my notes 1.18, and this is a full set of the financial statement. What I've just shown you there, they are just like, I just extract it. You can see, if you come back up, when we are saying full disclosure, you can see where I have a result at a glance. You are looking down to what director's report. These are part of the social requirement. You are looking at the responsibilities being signed by the directors of the company secretary. You are looking at the director's report. You are looking at auditor's opinion page, right? You are going down to your financial statement as a whole, your profit or loss. You are going down to your balance sheet. You are going back to your statement of changes in equity. You are going down to your cash flow statement, and you are going down to the notes. So this is the note I was explaining to you, but this note does not actually stop here. You can see this note does not stop here. This note goes down to be telling you, how did I derive certain revenue? I'm telling you, where does revenue comes from? Is the company generating revenue of billions? Where does it come from? I've done a breakdown of that revenue is coming from. I've even break it down to say the one that are vatable, the one that are not vatable, because the company have revenue that are vatable. So after them, out of this revenue that you are seeing here, vatable one is just this. This one, they are not vatable because it's from AppCon. This from rare, which is like an NGO. This also from UNDP, they are not vatable. So if I take this one to the tax office, and tax office want to place VAT, they are saying, and I've remitted the VAT for that year, and they look at my revenue, and they calculate 7.5% of this figure, and it does not align with what I've remitted, right? And they come back to me and tell me, you have insufficient VAT because your revenue stay this. If I want to reply to them, I will not give them the proper reply. I will tell them, go to my note 2A or the financial statement. You will see breakdown of how I've analyzed. If you now want information of what make composition of my words non-vatable income, I can now give you. But I've actually tell you this one are not vatable. You not ask me, it does not align. So you can see also other income. I'm telling you, the other income I've said in the financial statement. This is how I come about it. This is how I get that figure. And I've actually do a analysis. I've already tell you that my component of cost of sales, so some of them also are not vatable. This is how I arrive the figure, and that's how you continue to give them a breakdown of the expenses, income statement, profit and loss, and continue to go down to your fixed asset schedule, and continue. Whatever happened in this case, I think Heritage Bank was will I say they liquidate, and this company has this money there, and they have to transfer the money, I think, to Wema Bank. You can see Heritage Bank is now showing 0. So, and basically that is what you shows. Those are the related party transaction. You can see you are seeing related party transaction that is there. If there is any, is there any event after the reporting date? Comparative figure, contingent liability. If there's any contingent liability, recently I wanted to change a job, right? And I saw a company that want to give me, I think, about 90,000 above what I was earning. And I was talking to my mentor to say, should I take up the job? You know, the first my mentor told me, I've never thought about that before. He said, go and check whether that company have contingent liability. In my life, I've never thought about checking whether that company had a contingent liability. You know what I went to HMIC company house, download the financial statement of the company, and I want to go and check contingent liability, because he said the company can be doing very well. Low. What if they have a big contingent liability and that can swallow the company in the next 1 or 2 years? So I check. I see that they have never had any contingent liability, and there's no future one. So you need to mention it. Say the director confirmed there were no capital commitments, because we want to see that if I move to this company, will there any capital commitments, right? So, and the directors also affirming that there is nothing that is new to them. So these are just, and so on, disclosure that is required for them. And I don't think I want to go beyond that, because I also have that tax provision part of it, which we are not part of what we are discussing. But as part of IFRS is concerned, these are disclosure requirements that you're expected to put as part of your note to the financial statement. Do I have any question? If you like, I can send you sample of this part of one that is a blank one. It's not exclusive. I think it's always, you can always see it online, but it's also company by company.
I like. Thank
So,
you, sir.
so I can also share you part of it. You are welcome.
It's about to the machine.
So basically that is just it. So like I told you, one thing I always say is this: when it comes to also disclosure requirements, right? When it comes to disclosure requirements, it differs from company to company. And when I say differ from company, it differs in terms of operational level of the company, and also differ in terms of, let's say, what will I put it? Size of the company. There are some organizations that you never encounter that kind of operation because the company is just too small. So they don't have that complexity in them. Where there are some organizations, they have a lot of complexity because of the size of the company. There's a company you never have to deal with lease because the company is just too small. They are not having anything to do with lease, and you don't have to apply that standard. But as long as you are that particular item is actually applicable to them, then you need to apply that standard. I think virtually every company in Nigeria will apply service contracts. I think, because you are issuing invoice. I think virtually every company in Nigeria will apply service contracts. I think virtually every company in Nigeria, or even I want to say Nigeria, virtually every company will have to deal with property, plant and equipment, IFRS 10. Virtually a lot of companies will have to do with income tax or the VAT tax, because we always have that timing difference, and which you need to disclose in the face of the national statement. Why some at company you might never have to deal with, and that disclosure requirement is not necessary. But like service contract, I think because you are actually raising an invoice, and that is basically your line of business, you have to tell them how you are recognizing that revenue. Basically, I think, in my own opinion, I might be wrong, but I think I'm right. I'm not sure, but basically, I think you should do that. So, I don't know. If there's any question? So I'm
So
only,
so my own is maybe like a comment or question.
yeah,
You showed us the breakdown of revenue,
yeah,
and you're able to even put it in bracket of vertible and non-vertible. I
yeah.
would say this is the first time I will see an FX that will be like, put it like that, because most of the I would say okay, let me not say most of the Nigerian companies, I've not seen them break it down like that. Is it just maybe your own part of disclosure, or is stated somewhere that it can also be done like that?
So basically, my reason for doing it for this particular company is that I get this company about 3 years ago, 4 years ago, right? So the person that was preparing the financial statement does not actually break it down this way. And there's always issue with the tax office, right? There's always issue with the tax office coming to
Okay, now
say
I
that,
get.
and all it's
Okay.
because of tax purpose. That's why I did it, not because of
Oh,
IFRS disclosure. Because of tax purpose,
okay.
that's why I have to bring it down. Otherwise, I don't
Okay.
need to bring it, because the tax office is already like, no, your VAT is like this. So the first time, one of the issues I was even backing with is having to do with consultation with the tax authority, right? And I feel like, okay, if I don't want this thing to be going forward, so the next thing I really wanted to do is for me to break it down for them to say, this, see this, just see it on the face of announcement. Because at times, maybe tax authority has pain in the ask for me, like they just want to get on your nerve. Like maybe at times they don't sit down to write the letter or to read the financial statement. They just it's like, for me, I see them like they have a template in their office or in their system.
What's that kind of
They
feed
just
your
look at your
machine?
financial statement and plug figures in. They just plug figures, they just pick your figures from there and plug it in without looking to the notes. So I feel like the only way for me to shut you down, like, okay, make you look inefficient, is like, are you
Sorry,
not
oh.
looking at the financial
So I've been
statement?
talking.
So are you not looking at the financial statement? So it's not has to this does not have to do with um maybe it's not that it's not allowed for you to. I'm not sure anything is restricting you for disclosure. Disclosure has to do with giving as much more information as possible. So basically, anybody can say that this is where this company generates most of this revenue, even for investor or even for decision making internally within the management. They can actually say most of our revenue are coming from REA. Other components is not that significant. Here is actually 8% of our revenue is coming from, and they can actually see it. I think basically that is just it. But I'm not sure IFRS tell you to go deeper. But if you go deeper, I'm
Yeah,
not
that's
sure.
fine. Yeah, thank
I'm
you.
not sure
Yeah,
something is wrong with it. Yeah.
yeah. So even in the UK, the revenue service people doesn't reveal details about the FA. They'll just be picking figures anyhow. Now, wow.
Oh no, 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 no. This is what I can say about UK, right? And this is how I was trained to deal with HMRC in UK. My boss will tell me, let your working paper speak for you. So what it means is that in the face of the financial statement, I might not be showing these more details that I'm showing here, but my working paper should be cross-reference, linking and cross-referencing. Did I call that? We call that thing cross-referencing now. My oga correct me. If you click on it, it will take you to the where it's coming from. You will put a kind of link there.
Hyperlinking.
Hyperlinking, thank you. Hyperlinking, thank you. Hyperlinking. You tell me put hyperlinking. Once you click on that hyperlink, you take you to that page. So, and they were like, there was that I was working on work paper, like, why are we doing hyperlinking now? He's looking at this. He said, this work paper, if any issue, anything happened on this account, maybe in 2 years or 3 years, and you are not here, and HMRC comes and I want to give them information, I can just go to your working paper, turn it to a PDF, or even decide to give them an Excel that a layman, when they look at it, they won't just looking at my figure to be absolute figure. That even when they see my sum of all my revenue and they want to see details of my maybe AMCOM revenue, if they click on that hyperlink, it will take me to where the breakdown of all those invoices or posting or general ledgers is coming from, because I have to have that general ledger on another sheet that sum up to that amount of money. That if I click on that hyperlink, it will take me to that source and they can see. So my work paper should speak for me. So I don't think HMRC is like that, because HMRC is somebody that will refund you if you have excess payment. You can also go back and have a VAT reclaim. I've done a VAT reclaim with HMRC. So I'm not sure HMRC will be a pain in the ass on like Nigerian tax authority. I don't think so. But they can be, but I think they are not likely to be in the pain in the ass. One thing about HMRC is that just make sure you have your source document, verifiable document. And maybe for everything is synchronized to most of these softwares, you can actually file all your VAT either from, say, your QuickBook, because there's an integration with HMRC portal straight away. So if you're actually feeding everything properly into your accounting software, you should feed in directly in filing your report. I think that is what they are trying to do with tax promas, but I don't think it's going to be able to be possible. And the reason why I'm saying it's not going to be able to be possible is because there have not been any. For it to be possible, there must be a change of API between tax authority, FRS, and, well, let's say accounting software company, the people that use softwares, accounting software, Sage, QuickBook, the one they use in Nigeria, maybe Dynamics. Those companies must be willing to exchange API with FRS. But I'm not seeing that thing being happening, whether FRS is willing to exchange API with them, or even whether if those companies might be willing to exchange API, but does FRS have the technical capability that those people are requesting for them to exchange API? So I think that's where the deficiency is always coming from. I think that's where FRS is. They always tell me I think that issue they have brought it to maybe twice to say file it, whatever. But I'm not seeing it. They want to see your information directly exchange. That you don't need to go to most of these portals to do something differently. But I don't think technology-wise they are there. I think that's just the difference as far as I'm concerned. Another question, please. So I'm owing you all my slide. I'm owing you my calculation. And Sandra said you want this format, right? Hello? Am I off?
Sir. Yes, sir.
Don't
Okay.
give Sandra for free. Let her pay, Mr. Badru.
No wala.
Is that all, sir?
Yes. Or is there anything more you want me to do? Do you have to
I
have
think
anything
that's all.
outstanding?
Can we, please, can everybody help me appreciate Mr. Badu? Mr. Badu took this class, in fact, without taking a penny.
Thank you
In
so
fact,
much. We really appreciate.
he
May
just
God
said he's
continue to
my
bless
God, I
you.
cannot be collecting money from his boy. In fact,
More clients, inshallah.
Thank you, sir.
Thanks for spending your time. Thanks for having me.
I told you when that Mr. Badu is a very good teacher. I told you he's not a lecturer, he's a teacher. I know teacher, they teach very well. They teach one by one. So thank you so much, Mr. Badu. Really appreciate you, sir.
So if you
Thank
still
you.
need me, you can always call me at any time.
Yes.
I'll work
So
with you.
tomorrow we'll be taking that accounting from subdocument. So I'd like everyone to be attend as much as, because that tomorrow's class is also very important, because I'm taking from like from bank statements, which is something that I think every accountant should be able to do. Be able to prepare accounts from bank statements, from inventory record, from PP register, prepare a complete account. So I think everybody would need to be part of that class to benefit from it.
No,
So
that's where you
At
start
what
making
time are
small
we
money
starting
now.
tomorrow?
we start at 7 o'clock UK time. That's 8 o'clock Nigeria time.
Okay,
8 p.m.
thank you.
Nigeria time. So that's 7 p.m. UK time. Okay. Thank you very much, sir. I really appreciate you. Thank you. God bless you. So, like, if you have any issues with tax, Mr. Badu is a first point contact. He can always assist, like I said. He's very good in tax. I know tax is his major. Well, I think he has added IFRS to it now.
All right. So thank everybody. Have a nice weekend. So,
You
like I
too,
said,
sir.
if you have any issue, just you can always reach out.
Thank you so much, sir. Enjoy
And
your
don't forget your
weekend.
slide, so Mr.
Thank you,
Badu, so I
sir.
can share with everyone.
Of course, I'm sending to you straight away.
I'm calling to Atlanta, you know, okay.
Somebody is in Ojolegba.
Spirit too. Daddy Joke.
I'm sorry, Emma Bino.
It depends that
I'm
people that are not in this
sorry.
class, you can see, they are not in this class, they are just logging in.
No, I am. I am actually. It's just that
I'm
where I
just
am is
kidding.
noisy.
I'm
So
just
that is
kidding.
why I
I'm
don't
just
always
kidding.